Right. Hey, everybody. I'm Zac Albers with Albers Real Estate Group. And today I brought one of my favorite local lenders to answer some questions about first-time home buying. Questions I get all the time from people when they call me. How much do you need for a down payment? What the first-time home buyer loan actually is, whether you can get help with closing costs, how family gift money works, how debt factors in, kind of the whole process A to Z. So let's get into it. Before we dive in, Adam, do you want to introduce
Yeah,
yourself and tell people what you do and who you work for and what you do in the Springfield area?
yeah, I would love to. So my name's Adam Swenka. I work for Flat Branch Home Loans. We've been very fortunate to be ranked as one of the top mortgage lenders in the state of Missouri by the Department of Finance. I've been doing this for almost 20 years, believe it or not. I at a young age, had a passion for finance. Grew up on a farm in Iowa at the age of 6. I made my dad, who was a farmer, take me into local financial institutions so I could ask him questions because I was just fascinated with how banks could help the local community or financial institutions could help the local community. Um, so I've also, over the years, especially the last probably decade, I've been consistently ranked in the top 1% of loan officers in the country based on how many families that we help. And it's a magazine that does those rankings each year. Yeah. So that's a little bit about me. It's not just me. I have an amazing team. We've got Ivy and Kathy and Brittany. Ivy and Kathy and I have been together for getting close to
Long
10
time.
years. Long time, long time. And I had to bring them on because, just like anyone that's good at their craft, you get busier. I help a lot of previous clients, a lot of referrals from previous clients, of course, business partners like yourself. And in order to serve them at a high level, get back to them quickly. And I know we're going to jump into prequalification, doing that accurately so that there's not fires later on in the process. And I know we'll get into that more, but there's a lot that goes into all of that. And in order to do that and pull that off and close on time and communicate well, I believe that a loan officer has to have a team. And so that's Ivy, Kathy, Brittany. They're really what helps me make everything run as smooth as it does.
Yeah. So you kind of mentioned it. One thing that I wouldn't say I get asked a lot, but I have to explain a lot because I do get a lot of people when they contact us, if they have been pre-approved or pre-qualified.
Yeah.
A lot of times it's from a national lender or an out-of-state lender. And from a realtor perspective, which of those two things they have done is very important. And you can't always tell because lenders call
Yes.
a pre-qual, they call it a pre-approval or vice versa. I don't know about other states, but in Missouri, there's no rule or regulation about what you call that letter that I'm aware of. And so
Yeah.
it matters a lot. And so let's just talk about what the difference is between, we'll just use our terminology for it, but a pre-qualification letter versus a pre-approval letter, and what it goes behind that before your realtor takes that and then submits that with an offer.
Yeah. So pre-qualifications, even pre-approvals, unfortunately, it's the Wild West. As much regulation that exists in my industry, I see crazy things done all the time with borrowers that simply filled an application out, put their social security, date of birth, put their income in. And a lot of times they just kind of guess their income because, for a lot of folks, unless you actually look at your pay stub and try to calculate exactly, if you're paid hourly, trying to calculate exactly how much you make for that year, a lot of people will understate or overstate their income and they'll put it on the application. And I've seen some lenders not actually verify pay stubs, not look at W-2s, not look at bank statements, not even completely look at the application, but then issue a letter. Now, what I feel bad about is that a borrower that's not in the industry thinks that that's wonderful. That's so easy. I barely had to fill anything out and I get this letter. And they think that that letter is as valuable as the letter that my team provides, where we look at maybe 100 different things. We try to proactively look at the things that we know are going to come up later. And that's the big thing. The lenders that just hand the letters out, but don't actually review anything, the disservice that they're doing to the buyer, that the buyer doesn't realize, is that there are going to be things that are going to come up because all of these programs, for the most part, are government agency programs that have the same requirements. And we can get into that later because we do keep a lot of our loans. So we don't have extra requirements above and beyond the government agency requirements. But all of the programs have like a baseline of these things are gonna have to be submitted. They're gonna have to be reviewed, and then they're gonna have to be within the tolerances of whatever the loan programs will allow. I know you
Yeah.
and I have had some deals where another lender has provided your buyer with a letter, and then it was pretty obvious at some point in the transaction that that lender had not actually really reviewed everything closely. I know we had one where they had a situation, it was a divorce, and
Oh, yeah.
communicated that really clearly to the lender, but the lender didn't take that extra effort to actually go and talk to underwriting to see how, you know, how all that was going to work out in the end. And then it created an issue.
Right.
We really don't. We try, over 20 years, you can't say that you are perfect because that's impossible. But we are constantly trying to learn and stay in front of those things so that we get the hard things out of the way by the time that your buyer gets the letter. That way, when they find the house, there's already a bunch of things to do. So they have an inspection, they have an appraisal, they have a lot of those things that they have to take care of. They want to get the heavy lifting, in my opinion, out of the way before they get the letter and before they submit their offer. So you have the pre-qualification letter, which is the Wild West. I mean, that basically means that the lender didn't actually take it to an underwriter. To be fair, we mainly hand out pre-qualification letters. And Zach, I think you would agree, that's because most listing agents know myself, they know my team,
Yeah.
they know that I don't just hand those letters out. Now, in other markets, because I am licensed in 10 other states, some markets require a pre-approval letter. It takes a little bit more time, has to go in front of an underwriter. I would argue that our pre-qualification letter is on par with a pre-approval letter because we even have Kathy, who I mentioned is on my team. She is a former underwriter, so she looks at things really through a fine-tooth comb, if you want to say,
Yeah.
before we even hand that letter out.
So would you say, just in the simplest form, a pre-qualification letter is the lender taking what the purchaser has stated on their application and then saying this fits the basic requirements? Whereas more
There's
of
a
a,
spectrum.
yeah,
There's a spectrum to answer that question.
okay,
So some lenders, I believe their philosophy is they want to throw everything at the wall to see what actually sticks. They want to come across as the easy lender. They
yeah,
do that up front by just barely getting anything from you other than just a few bits of information, giving you a letter and giving you really this false illusion that this is going to be an easy process. But they really have no idea if your loan's going to close. And I know people find that hard to believe. And sometimes when I explain this to people, that like if they met with someone, hardly asked them anything, gave them a letter, and then we're going through like just asking for basic things like pay stubs, so that way we can make sure that we document income appropriately. They'll say comments like, wow, the other lender didn't ask me for that. And eventually, as they get through the process with us and that we explain everything to them,
yeah.
if the light bulb goes off and they're like, oh, that kind of is a big deal because I am going to have to turn those things in. I would rather the lender looked at those now versus later and maybe find a problem.
Yeah, and kind of to piggyback on that from a realtor perspective, and we didn't really hit on this, but it's very important that you have a local lender, in my opinion, somebody that the community trusts and the community of realtors trust, because it matters to me more if I get a pre-approval with an offer from Flat Branch than I do from just some random lender I've never heard of.
Yeah.
It changes the way I advise my clients and whether to take an offer or not. And then the second thing is you want that letter before you go searching for houses, because if you find a house, certain houses, at least in our market, move very, very quickly. And so you don't want to find a house of your dreams, go through the process of getting a pre-approval letter and then it getting sold out from underneath you because you weren't ready to make that offer. So
The single biggest mistake I tell home buyers is that most of them don't start the pre-qualification process early enough.
yeah, yeah,
And I get it. They want to see what's out there. And then they, as you know, they oftentimes find things sooner than they thought they were going to.
yeah,
And we certainly make that work. But if you take a borrower that makes their application, they've not started searching yet, so they're not rushed, they're not stressed out, takes 10 to 15 minutes to fill that out, takes a few minutes to gather just a few financials to send to us. Let us work on it for free. We do a soft inquiry, so it doesn't even count as a hard inquiry.
Yeah.
We end up doing a
I
hard
think
inquiry later
I
on in the
think that's one of the
process.
things people are concerned about is, well, I don't want it to hit my credit a bunch. And then the other
Yeah,
thing I
yeah,
hear a lot is, well, we may not be buying for 3 or 4 months. I don't want to
yep.
do it now because it
Good, good,
expires.
great thing to bring up. Yeah. So our pre-qualifications, we have to put an expiration date because even with the soft pull, that soft pull does eventually
Sure.
become non-relevant.
Yeah, yeah.
You know, so we do have to put an expiration date, but the person doesn't start the process all over. It's actually super simple. If they get to, 3 or 4 months, they haven't found anything, we check in with them. We just confirm, has anything changed? Still working at the same employer? Is your income the same? Can we do another soft pull on credit? Again, these soft pulls don't count as hard inquiries. Do that. Basically, the work's on us at that point to update it.
Yeah.
They just have to verify a few things. We might have them send us a new pay stub, especially if their pay has changed at all. And then we can easily update it and then it's ready to go.
Okay.
That happens all the time. I would say
Yeah.
more.
Oh, yeah.
I don't know what the percentage is, but it's a decent percentage of people that we pre-qualify, and then it might take them 6 to 12, sometimes even 1 to 2 years before they end up finding that house and making an offer.
Absolutely. It does save you time to looking in price points that, you may or may not qualify for as well.
Yes.
Although for me as a realtor, that's not that big of a deal, but as big.
Zac, you can speak to this more than I can, but don't you see sometimes people are pre-qualified, but they have no idea what an estimated payment would be
Oh,
on the
yeah.
price range?
No, I get asked very, very often, like, hey, what's the payment on X number of dollars? And then, there's so many factors that go into that because without getting too deep into the woods, but if the roof is 20 years old versus 5 years old, that dramatically changes your insurance payment, which
Yes.
dramatically changes your payment. And so there's a lot more to shopping for your payment than just the total amount, if that makes sense.
So when we pre-qualify someone, I believe a good lender is going to come up with 2 or 3 estimated payments in different price ranges based on the loan program, because that's the other thing that a buyer wants the lender to research for them. Out of all the loan programs, which loan program is going to be best for them? Sometimes it's one, sometimes it's a couple different programs.
Yeah.
Then after that's determined, calculating, 2 or 3 different price points, trying to estimate for them homeowners insurance, real estate taxes. We go to a great effort to circle insurance and taxes and tell them we're estimating those. But we really try to be realistic on what we're estimating.
Yeah.
What I do find, especially with the online lenders, because I click those buttons too, I'm just curious.
Yeah.
I click those buttons too, and they a lot of times I believe it's intentional. It's my opinion.
Particularly
that
with insurance.
They will underestimate homeowners insurance, real estate taxes.
Yeah.
And the borrower's like, well, the payment's less. Then they find out that you can't, just because the lender estimated those, at the end of the day, they're going to be the same regardless of the lender that you go with. You want to work with someone that's going to be realistic with you up front so that you're not surprised and stressed out later that your payment's $100 more than you thought it would be.
Yeah. I mean, the worst thing in real estate is surprises.
Yes.
So kind of transitioning, because you mentioned loan programs, but one of the things I get asked a lot is how much money do I need to purchase a house, right? And very loaded question, because there's, again, a lot of factors into that you need a really good lender to help you determine, a good agent that can walk you through different options. But, I don't hear it as much anymore. I think in today's day and age, most people realize you don't need 20% down to purchase a house. But that was something, especially early on in my career, I did hear some. But realistically, let's just kind of break this up by down payment. What are the different loan programs and how much money do you really need to be able to put down on a house?
There are several zero down or low down programs. Usually people are surprised that there's actually, oftentimes, depending on their situation, more than one of those. You have VA financing, which you're familiar with being a veteran.
Yep.
You can do it as little as 0% down, and we can get into closing costs on prepaid. You can oftentimes ask the seller for that, but I always refer that back to my realtor partner because based on the price point, if there's room there, to ask for closing costs and prepaids to be covered.
Yeah.
You have MHDC, which is through the state of Missouri. That's for a first-time home buyer, where they can get down payment assistance for the 3.5% and do an FHA loan. We have another program called Essex. So if you're not a first-time home buyer, or you make too much for MHDC, which that is a thing. Believe it or
Yeah,
not, there
yeah.
are programs. MHDC, I haven't talked about USDA, which is zero down, but those have income thresholds where you actually can be overqualified depending on what your family household income is. And in which case, it doesn't mean you can't get financing. You just can't use those particular programs. And I'm specifically referring to MHDC and USDA, where if you make over a certain amount as a household, you don't qualify for those programs anymore. You have to look at other programs. And then there's a lot of low down, FHA is a very common, not just first time home buyer. That's a misconception. A lot
Yeah.
of people think the only time you can do an FHA loan is if you're a first time home buyer, and that's not true at all. And with that program, that's 3.5% down.
That's typically when people say, well, I want to do a first time home buyer loan. Typically they're meaning an FHA loan is
Yeah.
what they've heard, right? Because there's no
Yeah.
singular first time home buyer loan anymore.
Yes.
I mean, like there's not a government loan that says this is just for first time home buyers only. And that, I think in the past there was, but that has not existed in quite some time. It's more of the FHA is what most people are referring
and
to
even,
by that. Yeah.
USDA, you don't have to be a first time home buyer.
Right.
That's another misconception. I've heard that before.
Yeah.
One really quick thing on the down payment assistance programs. So if there's a reason you need to do MHDC or Essex, one thing that my team really carefully goes through is we ask you, is there a family member that could maybe give you a gift? Is there an old K that's just sitting there that you haven't touched in a while? Are you sure that you don't have a down payment somewhere? And I bring that up because those are really good programs. But a lot of times, if you do have the ability to either get a gift from family or maybe to tap into an old retirement account, or maybe there's another source that you have, I would just encourage you to run it by me before you liquidate or transfer anything.
Yeah.
Doing the normal FHA program compared to some of the down payment assistance program, depending on the person's situation, can actually be a better deal.
Yeah.
If they just don't have the down payment, then those programs are a blessing.
Yeah. One other thing I want to mention that I see a lot, conventional loans, kind of your standard boilerplate loan. You can do it used to be as little as 5%, but I see a lot of 3% now.
Yes.
And then I know there are programs you can kind of stack on top of that to cover even the 3%. And so there's a lot of ways to get into a home with very little cash out.
Conventional now allows you to do as little as 3% down as long as one of the borrowers, so it's got to be at least one of the borrowers on the loan has not owned a house in the last 36 months. And the general definition for most first-time homebuyer programs is that if you are a borrower on the loan and have not owned or had interest in real estate in the last 36 months, you're oftentimes defined now as a first-time homebuyer.
So kind of transitioning just a little bit, we hit on it. I don't necessarily want to get into all of the individual programs. We can do that in another video, but we've talked about down payment assistance a few times. And so just from a really high level point of view, do you want to explain, again, not necessarily each individual program, but just kind of what that is?
Yeah. So typically, you have your zero downs like VA, USDA, and then you have your down payment assistance programs. I'm going to mainly focus just, MHDC, Essex.
Yeah.
So typically with down payment assistance, you have either a forgivable second, which that's what MHDC does.
Mm-hmm.
So it's a second that's out there that's forgivable over a certain amount of time. And I've got all those details for anyone because it is always changing. So, but I've got all those details written down that I always provide borrowers if they're interested in that. And then with Essex, there's a couple different ways to structure it, but usually you just get a better terms on the loan if you do what's considered a repayable second. And so you have your first mortgage payment, you have your second mortgage payment. And so that's oftentimes how the Essex loan is structured.
Right. And some of those have restrictions about how long you have to own the house or live there as a primary residence and that kind of thing to get that second loan forgiven. So I just want to point that out. There are some disadvantages to doing that, but they are really great programs.
Such a good point. Yeah.
They help a lot of people, but it's like anything. In real estate, so many people just focus on, let me figure this out to get you into a house. and don't really explain the cost benefit of it, right? And so there's a cost to everything. A lot of times, I would say, with maybe the exception of the VA loan, especially if it's your first time using a VA loan, that's the like gold standard program for me for a whole lot of reasons, but and as it should be. But just make
So
sure
often
that
people come to us thinking like, I've got to do this loan program.
yeah,
And we'll tell them like, if at the end of the day, if someone really wants to do something and they qualify for it, I'm not going to stand in their way. But a lot of times we bring up other things that they had not ever heard of
absolutely, yeah,
before, and they end up doing that.
yeah. Which is one of the
So that
reasons
I'm glad you
why
brought that up.
my team and I refer the vast majority of our clients to your team, because we try to spend a lot of time educating and giving all our clients the information they need to make whatever decision's best for them. And so your team and my team are very aligned in how we make sure to give information to people and tell people the pros and cons of all the different options. Because one thing about real
So
estate,
yeah,
especially if you're a first time home buyer or you haven't owned a home, is there's generally a lot of ways to do things. There's not one way to get
yeah.
you into a house. And most people that are telling you that are in it for a paycheck and not in it to help you.
One of the big things we see is that MHDC is not a very profitable program for lenders,
Right.
not at all.
Right.
And in fact, some lenders, because of that, and I'm not speculating because they've actually said it, they don't do that program because there's not much profit in it for them. And so what I have heard from borrowers that have maybe started somewhere else is that the lender was trying to talk down a program that they don't offer. And I just don't know that that's the right thing. If they don't
Yeah.
offer it, because it's not profitable, my hope is that the borrower understands that they're,
Yeah, and it's
not
I mean
speaking
it's
only to
extra
that program because they don't offer
work
it.
for the lender, right? It's
Yeah.
not as easy. And I think some realtors are intimidated by that as well, just because they feel like I don't have the knowledge of this program, or I haven't done it before, and so I'm hesitant to explain or tell my client about it. So the other big thing that we always talk about with people when they ask how much money they need, because down payment is only half the equation.
Mhm.
Generally, the other half is closing costs, and so closing cost is a big bucket of things. So do you want to
Yeah.
explain kind of what that is, just in plain language, like what is closing cost and why is it thousands upon thousands of dollars, as opposed to,
Yeah. Yeah.
a lot of times people pay more in their closing costs than they do in their down payment.
So to break up closing costs, you have your lender origination fee, which that's the portion that actually goes to the lender that you're working with.
Yep.
Then you have the third party charges that are required depending on the loan program you're doing. Lenders can't mark those up. Now, I will say I have seen loan estimates from other lenders, and for whatever reason, the cost can be different. They're not supposed to be making any profit on those third party fees,
Right.
however. So you have that. Then you have what's called prepaids, which are your real estate taxes for the property, the homeowner's insurance for the property, and then prepaid interest. And I really want to highlight that because that's become a bigger deal because, when rates were in the twos and threes, prepaid interest didn't make as big of a deal,
Yeah.
right?
Yeah.
If you closed at the beginning of a month, then you go almost 2 months before your first payment. I'll explain that a little bit more in a moment. But if the rates were at two or three, even though there's 30 days of prepaid interest, it didn't amount to as
Yeah.
much as it does
Yeah.
now. With where in rates, I do want to say historically speaking, rates are still in the low normal range.
Absolutely.
So anyone that thinks that they're going to go lower, I'm not holding my breath that they're going to go. I hope they do, but I just am not convinced that that would happen. But a big thing when people ask me how much closing costs are, one of the first questions that I've started asking them within the last couple of years is, well, what's your closing date? And a lot of times, that it's kind of confusion, like how would the closing date impact my closing costs? And I go, oh, depending on your loan amount, it can affect your closing costs by $1,000, by $1,500, by $2,000 if it's a really big loan. So part of that closing cost is prepaid interest. And whatever month you close in, there's not a payment due on this new mortgage the month you close in or the month after. It's the following month your first payment comes due. So if you close at the beginning of the month, let's say you went under contract right now. So right now is late June. Let's say you want to close August 1st.
Yeah.
you're going to go all of August, all of September with no payment. Your first payment's going to be due October 1st, not considered late until the 16th of the month. So there's some wiggle room in there depending on when you're paid to make your payment and not be late. But in that scenario, you have like 30 days of prepaid interest based on your loan amount and what the interest rate is. If you have a decent sized loan amount, that could be an extra $1,000 to $1,500, maybe $2,000 of closing costs, but you go 2 months before your first payment's due. Now, if you close like the end of July, like July 30th, you're going to have your payment's going to feel like it comes due sooner, and it actually is. Instead of, you won't have a July or August payment, but your first payment is due in September.
Yeah.
But as a result, your closing cost might be $1,000 to $1,500 to $2,000 less because you have less prepaid interest.
And I do want to mention on the taxes and insurance that typically the lender will want you to have 12 months of that into an escrow account. And so for real math's sake, say your property taxes are $2,000, that's $2,000 of closing costs that you're putting into account. Now you're not really losing that money because it gets used to pay your taxes and insurance, but it's real money out of pocket at closing that you have to come up with or find a way to offset, which we'll talk about here in a minute.
Let me break that down a little bit more. So it's for when you're buying a house, all the loan programs are going to require that buyer to have their homeowner's insurance paid up a year in advance. And that takes place at the closing table. That's not something, as soon as they go under contract, they're not writing a check for that.
Right.
I would suggest they don't do that. Just let's take care of it at the closing table.
Yeah.
I've had people try to be helpful and they do that. We figure it out, but it's just not the best way to do it. Okay, so you're always paid up a year in advance on insurance. That is because you don't want to pay something like that month to month. If that payment got lost in the mail and your house burned down, you just don't want to be in that scenario. It's not good for you. It's not good for the lender. All the loan programs require it. So it's not even it's not a option. But in addition to that, generally it's 3 to 4 months of real estate taxes and insurance. Now, you mentioned real estate taxes in 12 months. What happens is that, let's say you close on a house in December. The county's only going to care about who owns the house in December. Yeah. And that's not fair for your buyer if they're buying a house in December to pay 12 months of taxes.
Yeah.
12 months of taxes gets put in their escrow, but generally 3 to 4 months from your buyer. The rest of those months come from the seller at the time of closing.
Yeah. Good point.
Then collectively in that scenario, 12 months would be put into escrow and then would pay that tax bill.
Yeah.
So
in our market, and I'm just going to give a number just so people can kind of understand. It's pretty common for closing costs to run $6,000 to $8,000 ish.
I would say so.
And again, if you're talking about a luxury home there is lots of variables. If you get outside of our higher tax counties, Greene and Christian County, of course, that tax amount goes down pretty substantially. So there's a lot of factors, but I would say the majority of my deals are somewhere in that $6,000 to $8,000 range. And
this is why, going back to why it's so important for buyers to get pre-qualified in advance. So the lender, once they know their situation and has an idea on when they might close, they can really get close on this.
Oh, yeah.
One component that's hard to do is homeowners insurance is up to, we mentioned that already. And one thing I didn't mention, but is very true, is that the buyer gets to choose whoever they want for homeowners insurance. As you mentioned, Zach, depending on how old the roof is of the house they find, how far it is from the fire department, if it's a volunteer or paid fire department, all that matters as well.
Yeah.
That's one thing that we really tried to help estimate. And I feel like we're pretty accurate on it, but that's one that I tell people at the end of the day, you get to pick. I mean, you could choose the most expensive homeowners insurance provider. And I can't say you can't use them.
Right. It's going to cost you, but yeah, absolutely. Yeah. And so that's something that, if people are being very conscientious about their insurance rate and that kind of thing, that's something that we proactively ask, like, how important is this to you? Because you may love this house, but the roof's 13 years old. And in our market, 13 years old might as well be ancient. And the insurance company, I promise you, is considering that basically replaceable. And so they will either not insure it, which has happened recently where we've had deals almost die because they couldn't get insurance on the roof, or the rate is going to be extremely high. And so I've seen where we've gotten sellers to replace roofs because of that reason. And the original quote was 2 to 3 times what the new quote with a new roof is. I mean, that's how
Yeah.
impactful that is. And so that's an important piece of knowing kind of what you're after. And so all that being said, not we've scared everybody with, hey, you need a bunch of money. There are ways, one particular way in primarily that's used very commonly in our market to offset those closing costs, right? And
Yes.
so in the contract, we call that a concession. And essentially what we're doing is we're asking the seller to give us a credit to offset those costs at closing. So it comes out of the seller's pocket. It is extremely common in our market. It is something, especially in the, lower to mid range of the market. Sellers are pretty conditioned to know that that's an ask. But you do have to factor that in if you're asking for a bunch of money off the purchase price and a concession, that typically doesn't fly in our market. You have to kind of choose
Yeah.
one or the other, or a smaller combination thereof, and as our market changes, if we get into much more of a buyer's market, I'd say we're pretty balanced right now, but that may
Mhm.
change, right? And that's why it's important to have a really good lender and a really good realtor that knows how much you can get by with, right? Because my goal is always for my buyers
Yeah.
to save them as much money as possible. But there
And the
are,
programs have limitations on what you can ask for.
yes, that's very
Generally,
true.
our costs are pretty low, like our origination part, which is really the only thing we control. Keep that low. We do high volume, and so we try to keep that on the low end. But I have seen some lenders that are more expensive, and then there's a limit. The loan programs limit how much seller concessions you can ask for. Probably the biggest one where it comes up is like a conventional loan,
Hmm.
low sales price. You're limited to 3% unless you're putting 10% down or more. It's weird, but Fannie and Freddie, which really control the conventional market, have this thing where if the borrower is putting less than 10% down, you're limited to 3% of the sales price. So if it's a
Yeah.
$100,000 loan, take that times 0.03, you get $3,000 that you could ask for in seller concessions, which is probably not going to be enough. Whereas if it's a, $200,000 home, 3% down, you're
Yeah.
getting close. You can probably cover pretty much all of them. But then you have FHA, which allows you to do up to 6%,
Right.
which is going to be more than you'll need.
Yeah.
So,
Yeah. I don't think I've ever hit a cap on FHA,
yeah,
but we have certainly ran up against that on the lower end of the pricing market on conventional loans. And so something that definitely is an issue, but we do, I would say a lot, but we do a fair amount of transactions where we get people into a home with literally no money out of pocket. Like,
yeah,
they
oh,
don't
yeah,
bring a single penny to closing, and they are a homeowner. Now, I'm not advocating for that or saying it's a bad idea either way. I like everything. It all depends on an individual's specific situation, and there's a time and place for everything. But, again, pros and cons to everything, right? You don't bring any money down, you're
hmm
financing a lot of money, and you're paying for that over 30 years. And so typically 30 years. And so that's just something that, again, you kind of have to decide if that's the way you want to go. But I have helped people recently with rent being as high as it is, purchase a house, bring no money to closing, and actually have a house payment that's within 5 to 8% of what their rent is. Sometimes a little above,
yep,
sometimes a little below. It just kind of depends on what they were renting. But we have done that several times in the last really 12 to 24 months.
yeah.
And
And I
so,
know this is not the same thing, but so many people have a family member, grandma, an uncle,
yeah,
someone that has said, hey, if you ever buy a house, let me know because I'd like to help. And so, a lot of times, like on our final closing disclosure, it shows them bringing some funds to close, but that is really coming from like a family member that's
yeah.
decided to gift them money.
Do you want to, let's talk about kind of gift and retirement funds just very briefly,
Yeah.
just kind of the do's and don'ts, because there's
Yeah.
a process for that, as all things. Mostly think our government to make sure they like to know where all the money's coming from, and so there's a process
Yeah.
there that really needs to happen. So if you want to kind of go over that.
Yeah. So the biggest thing I tell people, like if there's one thing you remember when it comes to either a gift or an old retirement account, is that myself, Ivy, Kathy, Brittany, we're here to get you into the house. So what I mean by that is like think of us as like your coach to get you where you want to go. but before you do anything, run it by us. Because a lot of times borrowers are just trying to be helpful, and maybe they hear this and they're this video, and they go and talk to grandma, and the grandma goes to her mattress and pulls out $10,000 in cash and gives it to the
Oh
the
yeah,
person
yeah.
that wants to buy the house, and they go stick it in their bank account. Well, there's reasons that's going to be difficult to document. So the biggest thing I would tell people is, if you remember one thing about gifts or old 401ks or any other funds that you want to use for a house but you're not sure about, talk to us before you do anything with it, because we want to walk you through the easiest way to document it. And there are certain ways that it has to be documented. It's not our rules, it's government agency
Yeah.
rules. So when it comes to gifts, generally speaking, there can be some exceptions to this, but it generally needs to come from a family member. Um, Depending on the loan program, a fiance or a future to be father-in-law or mother-in-law can be okay with some loan programs and then cannot be okay with other loan programs. That's why it's important to run it by us before money's moved around.
Yeah.
Generally speaking, though, it's much easier than people think it is. For the most part, we tell people, if they're going to get a gift from a family member, just confirm the dollar amount with the family member. Don't transfer any money. Get you pre-qualified before the gift's even transferred. And then you help them find a house. They get under contract. We know the specific property address. We know how much down they're going to need. Then we tell them, have that family member go get a cashier's check made out to the title company that you're going to close at, and in the remitter put the donor's name. That keeps them from, like, we don't need much from the donor then, which is
Yeah.
nice. There is a letter that needs to be filled out just to confirm it is a gift. But back in the day, we actually, depending on the loan program, would have to get a bank statement from the donor. And donors don't, it's one thing to give money, but they don't
Yeah.
necessarily want to provide a bank statement. That can really be avoided now. The biggest thing, though, is talk to the lender before you start moving things around. When it comes to retirement funds, same thing. We really want to guide you through that, because this did come up a couple months ago. We encouraged the borrower to get the process started, and then it took them, in their mind, they thought, oh, this is going to be easy. And they started it, like, I think 2 weeks before closing. Well, that particular 401k administrator was super slow. And I think it was down to the wire before they actually got the funds to the borrower. That's again why, bringing it up to us, we walk you through what to do, because every situation, especially when it comes to old 401ks, is different.
Yeah, and something to just mention as far as the retirement accounts is, talk to if you have one, the
Yes.
administrator
Always
or
talk to your
advisor,
tax
because
professional. Yes.
you don't necessarily always have to cash those out to access the funds. Sometimes
Oh,
you
yeah.
can
So
borrow
common right
against
now.
them,
Yeah.
and you
Yes.
essentially, they're all different, but the best ones, you pay it back, but you're paying yourself interest into your own retirement account, which is pretty
Yep.
awesome.
If
And
someone's
so,
watching this right now, I would encourage them, just so that they know is an option. If you do a 401k, talk to your 401k administrator if there's an option to do a 401k loan, especially for the purchase of real estate.
yeah, yeah,
Most of my borrowers are surprised that that's an option. And as you mentioned, the interest that they do pay on it actually goes back to them. And also, there's a very usually low cost setup fee. People are usually pleasantly surprised. Maybe they don't even end up using that aspect for the purchase of the home, but they just have kind of peace of mind knowing that if they've got
yeah,
$20,000 in a
emergency fund, or
401k,
yeah,
generally speaking, they let you access half of that with a 401k loan. Of course, everyone's different. You have to confirm that.
yeah,
But for a lot of people, it gives them peace of mind that, wow, if I ever have an emergency, maybe I become a homeowner and I don't tap into it to purchase it, but
yeah. I
I
got to pay a
know that that's my
deductible for a
backup
new
fund.
roof or whatever. I've
Yep.
got this
Yep.
funds available. Yeah. So I think, we've covered most everything. One thing we haven't talked about that is really confusing to people is debt and debt to income. And
Yeah.
what is that? How does it work? How does it affect people? If you've got some things you need to pay off, should you get pre-approved anyway? Like, what's a lender role in helping people determine what their what I call it's DTI, debt to income, and what would need to be paid off or not be paid off, how all that works, and then what's included in debt? Is it my my trash bill, my electric bill,
No.
or
Yeah.
that kind of thing? If you kind of want to give kind of the overarching spiel on your
Yeah.
debt and DTI.
Yep. So debt to income. And the way that you would calculate that, you mentioned trash bill or utility bills.
Yeah.
Those aren't debts. You might owe something each month, but there's not a balance. Hopefully, you're on time on those things. But it's like where you actually go and you take a loan out, and that therefore generates a monthly payment. And one thing that people can get confused on are like student loan payments that are deferred. Depending on the loan program, there's a lot of cases where it may be deferred and it may say $0, but depending on the loan program, the government agencies may require the lender to actually count a monthly payment.
Sure.
So that's why it's important to get with us, because you don't want to just assume like, well, I have $100,000 in student loan debt, but it's all deferred. It's zero payment. So you don't have to count any of that. Not necessarily. So you take all of your monthly debts. This is also one thing that's been coming up a lot is like Affirm and Clarion and these things where like if you're going through an online retailer like Amazon, for example, it gives you the option to not make the full payment, but instead make payments.
Yeah, the short-term
for whatever
credit
you're buying.
options.
Yes, we ask that up front now because that's not going to come up on your credit report, but it is going to show up on your bank statement. And the loan programs do require the lender to count those payments into your debt to income ratio.
Yeah.
So we take all of your monthly payments for the debts that you have, not utilities, not trash, not internet, just the things that you've actually taken a balance out on. And then there's a monthly payment generated.
Credit cards, loan programs, things like that. Yeah.
Divide that by your income. Now, the nice thing is that we are able to use your gross income, not what hits your bank account, but most of the loan programs allow us to use your gross income. So I know that most people have health insurance taken out. They have taxes, of course, taken out. They have 401k contributions taken out. We're able to use your gross before those things are taken out. So you have your monthly payments. You can add that up, or we can do it for you. We do it for people all the time. Add that up, divided by whatever the monthly gross amount is. Now, if you're paid a salary, that's easy for us to calculate. If you're hourly, but your hours kind of fluctuate, there's a certain way that all lenders are required to count that. And then, of course, we have bank statement loans for self-employed people. There's other special investment property loans. That's a whole other thing. That debt to income ratio is just, it's different in those scenarios.
Yeah. Yeah. And so if somebody's got, credit card, say they've got, I don't know, $1,500 on it. And that's throwing their DTI off. I know Adam in the past has been able to help people kind of resolve that in the loan process to get them closed. And so
very, very common where they might have 5 different loans or maybe 10 different loans in order to buy the house that they want and get the payment where they want it. Part of it might be maybe they have some money to put down, but we have them put a little bit less down so they can use those funds to pay some things off at closing.
Mm-hmm.
And the benefit there is then we don't have to count those monthly payments into the debt to income ratio. I do tell people if you've not started the home buying process and you pay things off, that's fine. But if you're starting the home buying process, you meet with us, we pre-qualify you. We actually encourage you to just make your normal monthly payment, and then we'll take care of paying those things off at closing because it's less documentation.
Yeah.
If you send a check off a week away from closing to go pay something off, I know you're trying to be helpful for your lender, but the lender's got to wait for that check to clear, for it to post, and then get verification from that provider that it's been paid off. And I've seen situations where that's delayed closing, whereas if they would have just waited, brought that check in with them to closing, the day of closing, then the title company verifies that it's going to get paid off, and we don't have to wait for the check to clear to get posted, all those things.
Yeah, we're all about smooth process in our world. Ideally speaking, I would like you to be like, man, Zach and Adam, they didn't do a whole lot because we're doing it all on the back end because we're making it simple, right? And so that's the ideal world. We get into my tangent about people that say we don't do a whole lot, but a good realtor and a good lending partner, especially when they work together, should feel to you as a client like things went real smooth, right? And so but there's a lot of prep work and just a lot of knowledge that goes about how to do things so that you don't have issues that go into that. So last thing, and then we'll get out of here. We've spent a lot of time on this one. I do want to mention something that I get asked a lot is just like time frame. And of course, I know all of this isn't controllable by you or me, but I get asked a lot, okay, so how long but from the first call, how long can it be before I move into my new house?
Yeah.
And so, of course, some of that, I'll take my end of it first, and then I'll let you handle it. Some of it's how quickly we
Mhm.
find the house, right?
Yep.
Because you might look for homes for 3 days. I mean, shoot, I've gotten people under contract. I've met them and got them under contract on a house in 24 hours. But that's
Mhm.
not common. Most of the time, it takes weeks or sometimes months. It just depends on what you're looking for and what is available in the inventory in the market. But taking
Mhm.
that aside, assuming that we find you something relatively quickly, what does that time frame look like, Adam?
So it certainly helps if they're pre-qualified in advance because we've got everything already.
Right.
For the most part, we might get some updated items. Also depends on the loan program. For your specialty programs like MHTC and Essex, I usually recommend, like a 40-day closing if you can, like an honor before, because certainly with those programs, especially MHTC, we underwrite it, then that file also goes to MHTC for them to review a few things.
Yeah.
So I would say in general, generally speaking, most people do like a 30-day closing. This is like what I do all day. So we fully focus on things. You and I think, have had deals where there's been kind of extenuating circumstances and they've needed to close in like a couple weeks.
Yeah. Yeah. Yeah.
Sometimes there's an existing appraisal out there where they started with somewhere else that didn't work out and we're able to transfer it over, and that really helps speed things along. But people wonder like, well, what's the lender actually doing for 30 days? We're doing a lot.
Oh yeah.
So
Yeah.
we contact the title company to make sure that the title of your house is free and clear. We don't do that, but we make sure that the title company does it. We get the appraisal going, which appraisers, they're just like anyone that's any professional that's good at what they do, they're going to be busy. So that might take 5 to 7. Sometimes we get up to 10 days, just depending on how busy it is, unless you want to pay for a rush fee. We have to send you, collect documents from you, get that turned into underwriting if we don't already have those things.
Yeah.
So there's actually a lot for us to do.
Yeah. So, we say you get pre-approved, and that can be done. Adam's gonna cringe, but that can be done like within literally hours if there is an extenuating circumstance. But typically we see 24, 48, 72 hours, kind of depending on when during the week and what's going on.
If they're W-2 salary, decent credit scores, like everything makes sense. We've had people turn an application in and within an hour they've got a
Yeah. Yeah.
pre-qualification letter. The only
So
reason it'll take longer is because we're just trying to, like a borrower should feel like realize that we're working for free at that point.
absolutely.
So
Yeah.
it's not like the easy thing for us would be just to tell everyone they're good, but that's not the right thing to do. It's the easy thing, but it's not the right
Yeah.
thing. Yeah. When it comes to,
Yeah.
I
So,
think I,
then you find the house, you get it under contract. It's a typically like Adam said, 30 to 45 days. Again, there are ways to do that much faster if it's necessary, but
yeah,
it
yeah.
costs you a little bit more. There's a lot of factors in that, but 30 45 days, you go through your inspection process, the appraisal process, and then you go to closing. And then at closing, once you sign the paper, you get the keys, and the house is yours. There's a little more to it than that too, even on your end as a buyer. But yeah, typically, I mean, we can turn you around from start to finish in 30 to 45 days. And again, if you can't find a house, you can't find a house. It takes a little longer, but that's a good kind of a time frame for people to have in their minds, especially if they're renting right now and you're trying to figure out, hey, I got to turn in my 30-day notice, right? But I need to find something,
Yeah,
or my lease is ending. I tell people all the time, contact me 3 or 4 months before your lease
yes,
ends, so that
absolutely.
we can get the process started. And once you're at that point of like 60 to 75 days out, we can go find you a house, get you under contract, even if that contract period extends to 60 to 75 days. A lot of sellers will do that. Not all of them, but a lot of them will. Most of them won't do much longer than that. But there are ways to kind of do that. So that way you have some peace of mind. If your lease is ending, you already have a house under contract, you've probably already been through inspections, and you may have already had an appraisal by the time you turn in your 30-day notice. And that's the safest way to do that where, you're not going to be homeless, because
Yep.
that's when those extenuating circumstances that Adam and I talk about are typically people that are going to be without a home. They're not going to have a house if they don't get this done in a certain period of time. And so we will always do everything in our power to accommodate that. But you can often avoid being being put in that situation, because that's not a low stress type of deal. So
One final thing that I'd want to encourage people on if they're watching this is that sometimes there's anxiety with people on, will I qualify or will I not? I don't want to waste, they're thinking they don't want to waste their time. They don't want to waste our time. I tell people, like, I would say 10 to 20%, just kind of depends on the season, of people initially apply and they don't quite have everything working in unison enough to qualify. But our philosophy is it's never no, it's maybe not right now. So we'll actually oftentimes build a path forward. And sometimes that's just a couple of weeks of things that maybe they need to save up a little bit of money to pay something off or whatever it might be. Maybe it'd take a few months because they just started a business and they need to have that business for so long before they'll qualify. Don't feel bad about having us look at your situation and then developing a game plan for you. Actually, it's really rewarding to help people that maybe they've been told by 2 or 3 other lenders. The lender didn't really give them any direction. They get over to us. We, check things out. Sometimes we're able to help them right away. And then other times we're able to build them a game plan on what they need to do in order to qualify in the near future.
Yeah. And something we didn't hit on that was intentional on my part, because I'm going to probably dedicate a whole video to it, is credit scores.
Yep.
Because there is a massive amount to that. And what I will say, just as a kind of ending part of this video, is most people that contact me that say their credit's not good enough aren't correct.
Yes.
So, sure. And even if they are correct, but your goal is to buy a house, one of the easiest ways to start is to go get pre-qualified, have them pull your credit, and they can tell you exactly what to do to raise that score to the point where you are eligible to purchase using one of these loan programs. But I don't want to get, again, too far into that, because there's a lot to that. It's one of the most common questions I get. It's one of the most common points of contention or points of confusion that people have. And so we'll do a whole video on credit scores and how that works with real estate. But that being said, Adam, I appreciate you coming on. Thank you for all that information. Kind of the overall takeaway is, don't disqualify yourself. Mm-hmm. If you are interested in buying a home, the first step is just a free conversation. You can reach out to me. You can reach out to Adam. Honestly, probably reach out to Adam, because that's where I'm going to send you after I talk to you at first, because I'm not pulling your financials, and I don't need to know that. I don't really want to know all your financials. And so Adam can do that and kind of get you down the right path. And, here at my brokerage, we work with first-time home buyers in Springfield, Ozark, Nixa, Republic, all over Southwest Missouri, Branson, Marshfield, everywhere you can think of. When you call us, a live real person, a real licensed agent answers the phone. And if we don't answer and you leave a message, we will call you back immediately as soon as we are able to. And I know Adam's team is the same way. Actually, I don't know that I've ever called your guys' business line and not had the phone answered, but there's not automated. You don't get AI. You don't get any of that. You get a real human being that knows what they're doing and can walk you through it. So if that helped, subscribe to the channel, and we'll be doing a ton of these videos, breaking down buying and selling just one piece at a time. Thanks for watching. Absolutely. Thank you.